All right, guys. So what I'm trying to do now. So first of all, let me clear up some stuff. Right now, I am in St. Louis. I'm working for a pretty large company, a really, really large company. That if I mention their name, a lot of people will know who they are very, very easily. And I'm on a contract working with them that's going to pay around $20,000 to $30,000 a month. Um, I'm not sure how long I'm going to be able to have this contract. It could be a month. It could be 6 months, 7 months. Last year is about 7 months I was working with this company for. And now I am back. They have me in the same exact location. But this year I'm trying to make a transition from apartment to becoming a homeowner. So part of my research, what I'm trying to do now is to start researching and figure out what I can do or what I need to do to purchase a home. And I want to broadcast that and share my research with people. But I'm having a lot of technical difficulties um, with the place I'm staying in, the Airbnb I'm staying in. There's not really a lot of privacy in there. Um, my regular computer that I have doesn't really have a webcam. It's a gaming computer, doesn't have a webcam, so that makes that tough. And my Mac doesn't allow for dual screen sharing right now, so we're just struggle streaming. But either way, let's get down to what came here for. Um, what this is a prompt with ChatGPT Pro. I have the $200 version a month, ChatGPT, and I asked it to do a deep dive research to find um, grants around the metro Atlanta area where someone who's making income um, can qualify for a loan. Essentially, I know like when I go for a loan, they're gonna just basically ask me for a down payment, 10,000, 20,000, $30,000. They're gonna look at my taxes and my bank returns, and that's pretty much gonna be a process once I find something. But I'm not trying to buy a huge house. I'm trying to buy something small and affordable and um, fix it up. So I'm not really trying to put down a large down payment on a house. I would like to just do as little as I can, maybe 0% down, or and go that route. But so I'm going to be studying the options and see what is out there. So I'm going to read through some of this stuff right here and then see kind of where it takes us along this journey until I kind of have my house. My goal is to have it done by July or August, I think, or maybe September the latest is when I really want to be able to purchase my first one. So let's get started. First time home buyer mortgage and down payment assistance options in Atlanta Metro. Executive summary. A buyer earning $150,000 per year in Atlanta metro area will usually not qualify for most city, home, or 80% AMI down payment assistance DPA programs, which are designed for low to moderate home income household. So what is a AMI? When it comes to purchasing, let's see, do it this way. How do you do that? It's the ChatGPT talk thing where you just talk to it and it talks back. Is this it?
Hey there, what's up?
Okay. When it comes to buying a first-time home, or being a first-time home buyer, I'm reading this thing and it says 80% AMI down payment assistance. What does AMI mean? In context, the sentence says a buyer earning 150,000 in Atlanta metro area will usually not qualify for most city home or 80% AMI down payment assistance. I want to know what AMI means.
AMI stands for Area Median Income. It's a measure of the median or middle income in a particular region. Programs like down payment assistance often target people whose income is below a certain percentage of that median. So if you see 80% AMI, it means the program is available to those earning up to 80% of the median income for that area. If you're above that, you might not qualify.
Okay. Example include the City of Atlanta program administered by local housing authorities and many county home funded programs, which cap eligibility at less than 80% of HUD area.
So in
I'm sorry. I lost my train. Example includes the City of Atlanta programs administered by local housing authorities and many county home funded programs with capital eligibility at less than 80% of HUD area median income. Oh, well, there it is right here. Area median income AMI, and often imposes purchase price caps around 270K to 375K. I want to ask it, what is HUD? Let's see.
Hey there, what's on your mind today?
I wanted to know what is HUD, and the context is in the sentence. It says example includes City of Atlanta programs administered by local authorities and many county home funded programs which cap eligibility at less than 8% of HUD area median income and often imposes purchase price caps around $270 to $370. Can you explain that a little bit more and explain to me what does HUD stand for?
HUD stands for the US Department of Housing and Urban Development. They oversee housing policy, affordable housing programs, and guidelines, including setting area median incomes. When a program caps eligibility at less than 80% of HUD AMI, it means they're using HUD's calculation of the area's median income and only assisting buyers earning below that threshold. So HUD provides the official income benchmarks that these local programs rely on.
Okay. I'm trying to find a pen to write this stuff down.
All right, take your time. We'll wrap up.
Okay. I put all my pens away, but let's keep going. For a high income first time buyer who wants to keep upfront cash well under 10% and ideally below the $20,000 to $30,000 range, the most realistic levers are low down payment first mortgage, your baseline, 3% down conventional, Fannie/Freddie 90% LTV products when the credit and debt to income DTI are strong. PMI applies but can be canceled later. PMI LTV. 5% down FHA when you need more flexible underwriting. Mortgage insurance is required and can be long lasting at high LTVs. 0% down VA if eligible, no monthly mortgage insurance, but a funding fee generally applies. 0% down USD in eligible rural area, incomes and geographic limited, usually tougher at 150,000 income unless the household size is large and county limits are high. Okay, I might be slow, but I just want to make sure.
Hey there, what's up?
Can you explain to me what LTV products means? So in context, the sentence says 3% down conventional, e.g. Fannie Freddie 97% LTV products. When credit and debt to income DTI are strong, PMI applies but can be cancelable later. And what does PMI mean as well?
LT loan to value. It's the ratio between the loan amount and the appraised value of the home. So a 97% LTV product means the loan covers 97% of the home's value, leaving you to put down 3%. PMI stands for private mortgage insurance. It's usually required when your down payment is less than 20%. The good news is PMI can often be removed once you've built up enough equity in the home.
Doesn't all property require private mortgage insurance?
No, not all properties require PMI. PMI typically comes into play only if you're putting down less than 20% on a conventional loan. If you put 20% or more down, or if you use certain other loans, like some VA loans, PMI isn't required. It's mainly a risk protection for the lender when the equity cushion is small.
Okay, so I work with a large insurance company, and almost all of the companies, all of the homes that I see have homeowners insurance. Is that different from PMI?
Yes, they're different things. Homeowners insurance protects you and your property against damage, like fire or theft, while PMI is purely for the lender. PMI covers the lender's risk if you default on the loan. Once PMI is cancelled, your homeowner's insurance stays to protect your home. Both are often required, but they serve different purposes entirely.
So when it comes to PMI, when does it become cancelable, and how does that look as far as the mortgage goes? So let's say the payment is 150,000, and then you have the insurance. Let's say that's 200. How much would a PMI be? Where do they get their number from for the PMI amounts?
PMI is typically cancelable once you reach about 20% equity in your home, meaning your loan balance is down to 80% of the home's original value. You can request cancel at that point. Alternatively, once you hit 22% equity, the lender often cancels PMI automatically. The cost of PMI varies, but typically it ranges from about 0.3% to 1.5% of the loan amount annually, depending on your credit score, down payment size, and loan terms. So if you had a $150,000 loan, PMI might be a few hundred to over $1,000 per year, spread across monthly payments. Once you hit that equity threshold, though, that extra PMI charge disappears, lowering your monthly cost.
Alrighty, so 3% down conventional loan to value products. When the credit and debt to income DTI are strong, PMI private mortgage insurance applies and can be canceled later. 3.5% down FHA when you need more flexible underwriting. Mortgage insurance is required and can be long lasting at LTV.
Hey there, what's up?
Can you explain this sentence a little bit more? So it says 3.5% down FHA. What does FHA stand for? And when you, it says 3.5 down FHA when you need more flexible underwriting, mortgage insurance is required and can be long lasting at high LTV, high LTVs, loan to value.
FHA stands for the Federal Housing Administration. An FHA loan is a government-backed mortgage designed to help borrowers who may have lower credit scores or smaller down payments. The 3.5% down refers to the fact that you only need to put 3.5% of the home price as a down payment. Now, FHA loans are more flexible in underwriting, meaning they're a bit more lenient on credit scores, debt-to-income ratios, or other borrower circumstances. However, FHA loans require mortgage insurance for the life of the loan if you put down less than 10%. This mortgage insurance protects the lender and doesn't automatically fall off like PMI on a conventional loan. You usually have to refinance or pay the loan down significantly before you can remove it.
Is having mortgage insurance like private mortgage insurance, PMI, or whatever the FHA is requiring a bad thing? Or does it skyrocket the overall pricing of a loan?
It's not inherently bad, it's more like a tool that helps you buy with less down. PMI or FHA mortgage insurance does increase your monthly cost though. It won't skyrocket the entire loan, but it's an added expense, maybe a few extra $100 a month depending on loan size. The trade-off is it gets you in the home sooner with less cash up front. If you plan to stay long term, you can often cancel PMI eventually or refinance out of FHA insurance. So it's a balancing act based on your financial goals.
Okay. %0 down VA if eligible, no monthly mortgage insurance, but a funding fee generally applies. Let's see what VA is. Probably for veterans, but let's get more information on this.
Hey there, how's it going?
So another sentence says 0% down VA if eligible, no monthly mortgage insurance, but a fund fee generally applies. Can you elaborate more on that, please?
Sure. VA loans are backed by the US Department of Veterans Affairs and are available to eligible veterans, active duty service members, and some surviving spouses. The big benefit is you can buy a home with 0% down, no down payment required. Unlike conventional or FHA loans, VA loans don't have monthly mortgage insurance. Instead, there's a one-time funding fee, basically a cost to help keep the program running. The fee is often a percentage of the loan amount and can vary based on factors like whether it's your first VA loan or if you're putting any money down. Often you can roll this fee into the loan. So, while you avoid monthly insurance, you still have that upfront cost, but it's generally less burdensome over time.
%0 down USDA in eligible rural areas, income and geographically limited, usually tougher at 150K income unless household size is large and county limits are high.
Hey there, what's up?
All right, so another sentence I need you to explain to me a little bit more. It says 0% down USDA in eligible rural areas, income and geography limited, usually tougher at 150K income unless household size is large and county limits are high. What does USDA stand for? And can you elaborate more on this program?
USDA stands for the US Department of Agriculture. A USDA loan is a mortgage specifically designed for rural and some suburban homebuyers who meet certain income limits. One major perk is that it allows for 0% down. Like VA loans, you don't need a down payment. However, USDA loans are only available in eligible rural areas, so not every location qualifies. Additionally, there are income limits, typically restricting eligibility to households with moderate incomes. So if you're making more than around 150K, though the exact limit varies by location and family size, you might not qualify. In short, it's a fantastic option if you're buying in the right area and your income fits within the limits.
All right. I think I'm gonna wrap it up for there for today.
That sounds good. You've got a lot of solid info now. If anything else pops up down the road, I'll be here. Take care.
I didn't mean to tell her that, but just for the live. But it's a good place to start. See how things go next week. If I'll be able to hop on this, but I really have to get through all of this stuff. Kind of get an understanding of what my options are, and real estate is really, really interesting. I never really had a passion for real estate, but even my job is right now, I deal with a lot of homes, so I'm basically in real estate. So, but thank you.